Welcome to Jersey. Welcome to an island rich in its history and proud of its history, but scratch just a little bit beneath the surface and you will find technology everywhere you go. And that is what Jersey Tech Week is all about. That said, if you think this is day one, you've already missed a weekend of action. Here are the highlights.
We are so proud this year to have 21 entries to the Digital Design Challenge, absolute record breaker. Traditionally we'd have 9 or 10 teams competing in a hackathon, some of which would make it through to the end, which is always a marathon. But this year we've really scratched beneath the surface of Jersey, unearthed some incredible artistic and creative talent, and have 21 entries.
Digital is something that we support both from the local community as well as the skill set that we have got within David G. So we've got our digital team, and it's always at the heart of our operations to help build the digital skill set within the Channel Islands and within Jersey.
It's great to see a variety of digital content. Sometimes when we think of creatives, we just talk about digital media, we talk about photoshopping, we talk about those kind of things. But here we've got birdsong going on in the background, we've got music happening, we've got virtual reality. It's been such an eclectic view and such a disparate example of what technology can bring.
See you online tomorrow at 12:30. Everybody else, thank you for coming.
That is a lot of talent on display, and that is what the next 5 days are all about as well. We've already seen some of the genius of the weekend. Let's find out what's in store for you. Tony Moretta, the CEO of Digital Jersey. This is going to be an exciting week, but I have to say from the outset, it's a week that's just going to feel different, Tony.
Well, doesn't everything else this year feel different? And we can't be any different from anyone else. And it's a great shame we can't have sort of physical meetings. We get the industry together, we get people in from off island as well. But actually, in some ways, the silver lining of Virtual Tech Week is it's easier to get the message out to people around the world that maybe don't get a chance to come to Jersey.
So, over the next 5 days, what are the sort of things we are going to be talking about, and what are the sort of things we're going to see and do?
So, as ever with Digital Jersey events, we're going to try and get a combination of bringing interesting people to Jersey to talk about what they're doing elsewhere in the world so we can learn from it here, and also allow people in Jersey to show off about some of the things that we're doing here as well. You know, to talk about why Jersey is a great sandbox, to talk about the amazing infrastructure we've got, and you know what we've got through COVID, and we went through lockdown in a way that few other places could. You know, we had gigabit fiber for every household. You know, we were able to work remotely in a way that lots of other people didn't have the confidence to do. And so it gives us an opportunity to show off around some of those things and also learn a bit as well. You tell people off island what we have and they're amazed. They say, how have you got that with the small island? When we used to talk about digital transformation, that's now about digital resilience. So what we've seen this year is that actually, if you're a company that can carry on running digitally, you can preserve a large proportion of your business. Particularly, we've seen the finance industry here being able to carry on almost as normal, because they can carry on working from home, they can carry on dealing with customers, and even businesses that probably didn't think they'd ever have to have a digital business. You know, restaurants who've never done home delivery, shops have never done online ordering. They've all realised that actually, if they adopt technology, they make themselves a more resilient business.
And you know, that's something I really want to get out of this week. Is we've spoken in the past almost of a digital sector and a digital silo. It strikes me this year as proof that's nonsense. Digital is everyone, everywhere. On the map, we are very, very small, but it strikes me time and time again, our pull is utterly disproportionate.
It's an overused phrase about Jersey punching above its weight, but it's true. And we do it in so many different ways. And it's about time we started shouting about our digital sector in the same way that we've been shouting about our agricultural sector and our finance sector for years.
I think we need to get this shouting properly underway. Do you want to get us started, Tony?
Okay, let's roll VT, as you'd say in your industry, Carey.
Well, good morning, everybody, and welcome to the amazing Jersey Tech Week. The opportunity to take part in an event like this, which has been created from the ground up to be a mixture of physical and virtual activity, it's amazing. And the guys in Jersey have just done an incredible job of creating this new kind of event, which I'm very flattered to be asked to take part in. When the virus came along and we stopped having sort of physical events, people started to create virtual events which were a sort of simulation of the physical, and to be honest, not that much fun. Whereas now we've moved into kind of a new way of doing these things, where we're building things that are designed. Look, this mixture of physical and digital is just amazing. You know, there's that saying, when life sends you lemons, you put them into gin and tonic or something. I can't remember exactly what the saying is, but it's something like that. Or making a virtue out of a necessity. Well, we've gone further than that, because by bringing together the physical and the virtual in this way, we've created an event that brings in expertise from all over the world and showcases Jersey to the whole of the world at the same time. Now, the virtual, which by the way is not a substitute for physical anymore. I mean, at the beginning of the pandemic, you know, if you went to an event and somebody came in on a screen or something, it was a little bit unsatisfying. It was a bit annoying. But of course, now we've all lived through the kind of new Zoom era. So now we're used to seeing people on screens. If somebody is telling you about, I don't know, the relationship between digital currency and the ability of central banks to add to their monetary toolbox while our husband's putting on her pajamas in the background, you don't bat an eyelid anymore. It's just the new normal. And I think we can make events like this, which are just a cut above what we can reach out to people all around the world, and that's what we've been doing. The ability to add virtual to these things. Yeah, so for example, there'll be some people that are here physically. This is what I mean by mixed physical and virtual. There'll be some people that are here physically, and there are some people coming in virtually, like me, for example. I'm actually a hologram that's being beamed in at this very minute. Unfortunately, the Java method about beards has crashed, but we're going to see if we can get that fixed after the coffee break. The ability to mix the physical and the digital, I don't want you to think this is just an experiment. This is the way things are going to be done from now on, and Jersey is taking an amazing lead in linking together these sort of international speakers and the energy that's going into it, and it's just fantastic. So all of which is a long way of saying I was just really flattered to be invited to be here and to help kick off this fantastic event. We've got 10 sessions for you all of this week. For reasons which are not entirely clear to me, they're all free, but anyway, that's their decision. I'm not on the commercial side of things. And in order to get things kicked off, we're starting with fintech. You know, to me, one of the most important aspects of the new collision of technology and regulation is what it does to fintech. And so it's absolutely fantastic that I'm able to be joined on the sofa here today by the head of Fintech for Digital Jersey, Jason Laity. Thanks very much for being here, Jason.
Good morning, Dave. Thank you for that introduction.
I'm not over-egging it, right? Fintech is absolutely central to where Jersey's going.
It is where we need to be. It's the future, and it's very fitting that it's the first session of what I'm sure will be an amazing tech week for Jersey. So as you said, we've got amazing speakers lined up.
Which we wouldn't have thought of having in what I think of as the old days.
That's right. We've got speakers from all over the world. We've got speakers locally. We've really got an amazing lineup. And as you say, it's all for free. Who would have thought? So as you say, today is Fintech Day, and the kickoff sessions are sponsored by Carey Olsen. We're very grateful for. We, of course, as you say, have a fantastically successful financial services industry in Jersey and a growing tech industry. And we really do believe that we can create something special at the intersection of the two, as you say. Other than that collaboration between the tech industry and the finance industry, we're also really working on aligning the various government agencies, ourselves included, around that common goal of making Jersey a real best-in-class destination for world-class fintech. And you can see that with our new Jersey for Fintech banner and imagery, which you'll see around today. So you'll hear much more today about the importance of collaboration between industry and regulators in all of the discussions that we've got today. Really looking forward to it, Dave. And with that, back to you.
Thanks again for inviting me, Jason. I really appreciate it. So, Jason asked me if I could say a few words to set the scene for Fintech Day. And what I thought I would do is just try to explain a little bit about the big picture and some of the questions that are going to be discussed during the day. And some of the areas where, Jersey has I mean, I wouldn't be here if I didn't think Jersey had a real opportunity to seize some of the potential here and make something of it. And I think the way to think about it is probably sort of in three main areas. I mean, these are high level labels and you see what I'm driving at, but I think broadly speaking, if we're thinking about jurisdictional competition around fintech, which is what we should be thinking about, there are probably three key areas that we should focus on: digital money, digital identity, and what I've taken to calling digital diligence. And I'll just super quickly explain what I mean by those and show you how they're going to relate to the themes of the day. On the digital money side of things, we have a sort of period of kind of, it's one of those periods of change where you're not quite sure what's going to happen, because for a long time, we've had a fairly stable, we're used to where we are. We had a certain set of, you had the central banks and the clearing systems, and these things were set up, and certainly for most of my working career, you had BACS, and then you had faster payments and things like that. But now we're moving to this new era of kind of interconnected, instant credit, global settlement. I mean, you'll be hearing about this a little more with my good friend Nick Ogden this afternoon about the interconnection of RTGSs to flow money around the world, and the platform that creates for new products and services, request to pay and things like that. But there's another wild card in that space, really, which is digital currency. Because if you go back not that far, the only people talking about digital currency were sort of, techno hype merchant, science fiction nutters like me, and people who were mucking about with Bitcoin, really. And that was what, but you're going back a year now, you had people like Mark Carney, who was then the governor of the Bank of England, standing up and saying it was probably time to look to technology for what he called a synthetic hegemonic currency, an SHC. In other words, some digital alternative to fiat currency. And since that time, the central banks of the world have piled into this, and now they're all, researching digital currencies of one form or another. And in China, it's already launched. We have a panel on digital currency later this morning where you'll be hearing from people like the Bank of International Settlements about what's happening in that space. So the money space, you've got this new energy going into the interconnection of the global instant credit networks and the wild card of digital currency, which I think we all have to take pretty seriously, because that could be a fantastic opportunity for Jersey to drive a stake into the ground around this entirely new business that will spring up around that. And by the way, I mean, digital currency is emblematic of a whole digital asset infrastructure which is growing up. And when that infrastructure is properly regulated, it's going to be a hockey stick. And you can ignore people like me saying that, it's just some guy saying it, whatever. But last week, Jay Clayton, who's the head of the SEC in the States, said in time, everything will get tokenized. Everything could be tokenized. So digital money is changing. A lot of the things that need to happen in fintech to reduce the overall cost of financial intermediation and make the sector more efficient and to crack some of the problems around exclusion and so on is actually nothing to do with money. It's about identity. It's getting hold of that digital identity problem. And the virus has thrown it into pretty sharp relief, because when we were talking about this before in the Jersey proposition development groups, we were talking about digital identity as like a nice thing to have, a way of improving things in the future. But what's happened, of course, is the pandemic has shown the absence of that infrastructure has proved very problematic for many people around the world. And by the way, that's not just the identity of people, that's the identity of businesses as well, because getting subsidies to people in times of hardship, as well as supporting businesses, is incredibly difficult if you don't know who anybody is and who runs things and who's in charge of things. Jersey has a fantastic opportunity to step forward in that because of the infrastructure that's already here and actually the experimentation that's already been going on with Yoti and other things. So it's finally time to crack that identity nut, and Jersey has a fantastic opportunity to, especially because of the infrastructure in terms of the broadband, 5G, and the things that you need to bring digital identity alive. If you think about it, you probably use your identity far more times every day than you use your money. And so if we can make that more efficient, we can really make a difference. And that leads me into the sort of third area, which is digital diligence. And here, the fundamentals of jurisdictional competition come into play. Jersey prides itself on having a very well-regulated sector, and it's one of its biggest selling points. But around the world, the costs of that regulation have been spiraling out of control. The costs of compliance are just unbelievable, and the cost-benefit analysis around it is becoming more and more difficult. So it's time to think about doing things in a new way and using the new technologies. We all understand what those are, artificial intelligence and machine learning and so on, in order to make the due diligence processes a step change more efficient. And that might mean, for example, one of the ideas that's been discussed before is having some form of financial services passport for the island or for the Channel Islands. It may mean a very different way of policing financial transactions by collecting more data and feeding it into these machines. But whatever it means big changes. And so because, look, if you look at where fintech has come from so far, some incredible new products and services, the overall cost of financial intermediation hasn't really fallen because every advance in technology is met with some more regulations. So understanding how to do better in that space, it plays a really big part in Jersey's future. So actually, that's going to be our first panel of the morning. We'll be discussing that. So if you put those three things together, what you see is a landscape where some of the some of our sort of conservative assumptions that things are going to stay pretty much the same, but with a little sort of chrome wash veneer on top, this can't be true, because changes in digital money, digital identity, digital diligence are going to reshape the financial sector. And I think one of the things it will be interesting to observe during the day are the narratives around that new financial services sector and how they fit into the sort of global picture. And if I had to pick out one theme about that, because obviously I am fortunate enough to be involved in one or two events around the world on these kind of topics. If I have to pick out one theme, I might be very tempted to point towards the idea of financial health rather than financial services. The UK's Open Banking Review last year found that the impact of open banking on the average consumer was really very limited because it's siloed. If you get some data from somebody's bank account, it doesn't actually tell you that much. You can't help them that much. But in times of stress and difficulty, if you really want to help people, you need to take a much more rounded picture of their circumstances, which means capturing data, not just from bank accounts, but from savings and investments and mortgages and pensions and lots of other things that Jersey's good at, and putting that stuff together, where the advent of things like artificial intelligence mean that if you get this better picture of people, you have an industry that has an opportunity to measure itself on their health, their financial, a sort of national wealth service if you like, in a way. So what we see these changes in the underlying technologies and drive forward. But what for? And I think this is where Jersey's ability to connect with global change gives it an incredible advantage. And I hope that, getting TechWeek kicked off in this way, making the most of this new mixed physical and virtual format, bringing in speakers from all around the world and sharing some of these ideas with people all around the world who are going to be looking at these videos, I hope, means that we can really achieve something that I don't think we could have imagined a couple of years ago, because then we were talking about using technology to make some marginal improvements in the efficiency of financial services. We weren't talking about reshaping the sector. And as Jason mentioned, Jersey's a little bit special in this respect because we can get the regulators, the technologists, the financial services companies around the table with an infrastructure they can use to begin to experiment and pilot and try out some of these new ideas. So the idea that we're just going to talk about, how we can make things a little bit better in one or two places, no. What we're talking about is how the new opportunities to reshape the financial sector are coming into view. And if I had to pick one of them, which will make the biggest difference, and this will come as no surprise, I mean, lots of people on Jersey talk about the same thing, it's actually not fintech, it's regtech that will make the big difference. So I was really happy that we're going to have the closing presentation this morning from Charles Dellingpole from one of the most important companies in that space, which is Comply Advantage. So I hope I've given you a sense of why I think it's such a big deal, why I think it's incredible they've put this event together in this new way to take advantage of these things. And now we're going to get the morning kicked off with our first presentation, my good friend Heidi Peterson from HSBC. And if I turn around, I'm really sure that she's going to be there ready to. Good morning.
Hi, Dave. How are you?
I'm actually fantastic. I'm really very excited about this idea, and I'm so happy that you were able to join us for it, because I think some of the research you've been looking into really frames some of the questions that we need to be asking today. So thanks very much for making the time, and I'm going to hand over to you now. So take us through your research.
Thank you, Dave. Right. So I think just initially what I want to say is that the research that I did was part of a personal research process and wasn't part of anything that my employer was involved or mandated me to do. So these opinions are my own, but I wanted to share them because, like you, I'm hoping that we're going to spark some conversations and get some collaborations going. So essentially what I wanted to talk about was crypto assets and Jersey, but in the context of reputation, because whether we crypto assets, whether you love them or you fear them, they are a thing. And I wanted to understand their impact for Jersey. So my research questions that I posed myself were, first of all, should Jersey's strategy to be an innovation hub for fintechs include attracting crypto asset businesses? And if yes, then will this negatively affect Jersey's reputation as a robustly regulated and transparent IFC? So because this was an academic process, my methodology had to be quite rigorous. So I started with a full review of the literature, the peer-reviewed literature that was available on the broad subject of crypto assets. And although this is a relatively new technology in research terms, there was a great deal of literature on this asset class, on their use cases, on their regulation, on the opportunities and the threats for the financial systems, which was great. But there wasn't any real literature that spoke to how this new asset class specifically could achieve adoption, and if it did, would it affect adopters from a reputational perspective? So these were the sorts of things that I wanted to So the next step of my process was I set up and I conducted a range of semi-structured interviews with people across this island, across the UK, across some of the other IFCs. I spoke to people in Malta, Gibraltar, and Bermuda, and I even chatted to people as far afield as the US because I wanted to gauge opinions on these questions. Once I'd done that, I followed this up with a broader-based online survey because I wanted to corroborate what people were telling me with what the broader community felt about these topics. So for the interviews, what I essentially did was I conducted these over a period of about 6 months, and most of those interviews were conducted pre-lockdown. Just want to say that at the front. And they were mostly in person, and I spoke to what I call a purposeful sample of 21 people. These were individuals from across the financial services industry, from policy advisors, fintechs, educators, regulators, and I chose this as a sample as I needed people to know a bit about the subject matter, but I also wanted leading voices on the topic, whether it was for or against. These conversations then generated statements and topics that I was able to distill into 4 broad themes. And those 4 broad themes were adoption, regulation, innovation, and reputation. So then I used those themes and I designed an online survey which was built on a commercial platform called Question Pro. And this survey posed 37 questions or 37 statements that I took from the literature and from the interviews. And these required the respondents to just use a simple scale to show whether they agreed or disagreed with these statements. So on a scale of 1 to 5, with 1 being strongly disagree and 5 being strongly agree, I asked people to answer these questions, and I used this method because I could then use the numbers 1 to 5 to help with the coding and then help to quantitatively analyze those trends at the end, which all sounds very fascinating, but really wasn't. At the end of the theme section, at the end of each theme section, there was a free format section. So if people wanted to add additional comments, they could do. It wasn't mandatory, but 12% of the respondents provided commentary to me, which added an extra layer of insight into what people were thinking about this topic. This was then distributed via Jeff Cook and Digital Jersey's LinkedIn profiles. And I asked them to distribute it for me as I'd looked at who their follower base was, and it largely fitted the profile of the respondents that the survey needed. So, and then I also sent the link to about 60 other people to forward on to their colleagues and contacts in the industry. So that meant that I had about 9,500 people that could theoretically access this survey. Of them, 705 viewed it, 364 started it, and 280 people fully completed it. So who were these people that responded? Well, 83% of them were from Jersey, which is exactly what I wanted because obviously this is Jersey related. 9% were from the UK. One of them was from Wales, and I suspect that was my mother. So thanks, Mum, for that. 5% from Europe, 2% from the other international financial centres, and 1% of the responses were from the rest of the world. So in terms of industry breakdown, this is what it looked like. We had 21% from banking, which covered corporate banking, investment banking, and retail banking. 27% were from non-banking financial institutions, 13% from fintechs, regtechs, and blockchain consultancy type businesses. 8% was from the accounting, the audit, the tax, and legal advisory. 11% was from regulatory, and I was very pleased with this and frankly quite surprised. I didn't expect such a good response. And then there were a smaller amount of responses from crypto asset exchanges, financial services industry groups, and Jersey Financial Services and Digital Jersey were incorporated into that group. And then we got 6 responses from other industries, which included things like tourism and retail, and quite strangely, also one plumber who also incidentally actually was one of the people that had a lot to say in the free format section. So I covered all the industries. Anyway, in terms of the roles of the people that responded to the survey, this is what it looked like, and the large majority were senior managers, directors, and C-suite executives, which was exactly the people I was targeting, as I wanted the key decision makers to provide their opinions. All of the respondents were also asked to comment on their organization's involvement in crypto assets, and only 5% of them said that their business was fully crypto asset focused, which is not that surprising. But the bulk of the responses confirmed that they had no involvement, with only some of them intending to actually develop products or services in the future. So that was quite interesting for me as well. And then finally, 62% of the respondents felt that they had a good knowledge of crypto assets and that they keep up to date. Only 4% considered them innovators, and 7% said they knew very little and had no interest. And just to say that at that point in the survey, the 7% that said they knew very little and had no interest were then exited from the survey. Their numbers were still counted as having completed the survey. So that's all the methodology, and that's all the who we targeted and who responded. So let me show you the results. And again, I've broken these results down into the 4 themes. So let's start with the adoption theme. Across all the industries and all the respondents, there was a general agreement that crypto assets were not a fad and were in fact a new asset class, and that these businesses needed access to traditional banking services for growth and adoption. In the same way, respondents disagreed that Jersey's financial sector would be unaffected by crypto asset adoption, and that this new asset class was mainly used for illegal purposes. They disagreed with that. Where the respondents were indecisive was that, on average, and these were the questions that we asked them, where they were indecisive was that was on those questions. But I broke it down further. I looked into it a little bit further, and when we broke it down into the industry sectors, the responses were actually split into 2 camps that either agreed or disagreed. So the regulators and the banking organizations were considerably more conservative and did not agree that crypto assets would replace traditional financial services. And they strongly agreed that crypto assets were too risky for investment portfolios and too complicated for the public to adopt, or that crypto assets would achieve mainstream adoption in 5 years. The rest of the industry sectors, including the non-banking financial institutions and the advisory industries particularly, and for me quite interestingly, were far more bullish on these points. So when we look at the regulation points, all the industries agreed that regulators should provide a supportive environment for crypto assets, and that this was driven by non-criminal investigators wanting the protection of regulation. So that was good to see. On the disagreement side, they felt that crypto assets should be regulated by central authorities. In other words, they disagreed that it shouldn't be. And I was surprised to see that respondents from the Fintech and the virtual currency exchange respondents were actually quite vocal about this point, with several of them commenting that their businesses were already designing processes with centralized regulatory compliance in mind, even though it wasn't mandatory at this point. Where the industry could, where the respondents could not decide on, was related more to the how of regulation. And these were the questions that they were responding to. What was a little disappointing was that in this section, although there were 19 respondents from the regulators in Jersey and the UK, 68% of their responses were non-committal. In other words, they chose the option that said neither agree or disagree, which was a little disappointing for me because I would have really liked to know how they felt strongly, at least a little bit more strongly about these points. However, in the commentary in this free format section, there was a lot of talk about the need for bespoke regulation for a broader swathe of crypto asset businesses. So one comment noted that really only ICOs and VCEs had relevant regulation. So it looks like there is a bit of haziness as far as industry is concerned when it comes to the regulation. Anyway, let's look at the innovation theme. So overall, there was an agreement that that Jersey could compete with innovation hub, and that the economy would benefit from attracting crypto asset innovators. And again, this was from across all the industry sectors. Surprisingly, there was also an agreement that disruptor banks or fintechs would erode traditional market share. And I say it was surprising because even the banking respondents agreed with this too when I drilled down into the results. This was backed up by most of the sectors disagreeing that financial service organizations were keeping up with fintech advances. However, here, the banking sectors had the opposite view, perhaps not surprisingly, in that they felt they were keeping up with the fintech innovation. And although respondents felt that Jersey was competitive as an innovation hub, and as previously shown in one of the other themes, they agreed that crypto assets was a new asset class. Paradoxically, it seems that they're unsure whether crypto assets should be part of that innovation offering, and that was the section that they were undecided on. Finally, in the reputation section, these were the bits that they agreed with. So first of all, I do want to say that over 92% of the respondents agreed or strongly agreed that Jersey has a good reputation as an IFC. Interestingly, 8% that I disagreed or strongly disagreed were actually from Jersey. All of the international or non-Jersey respondents all agreed or strongly agreed that there was a good reputation, which for me was very nice to see. With a slightly lower proportion, they also agreed that the regulatory framework supports a test environment for fintech innovators. So there was a definitive disagreement on the statement that crypto assets would chase out financial flows or would cause a proliferation of financial crimes. But most respondents, and this is really the crux of the research, most respondents were not able to agree or disagree to the pivotal question of whether crypto assets, of whether attracting crypto asset innovation would harm Jersey's reputation. One final question in the survey that I did also ask required that a series of characteristics from IFC be ranked in order in terms of importance to the offshore customers, 1 being most important and 10 being the least important. And from this table, we can see that the aggregated results for this are quite interesting. Well, at least for me, they were. The most surprising outcome for me was that geographic location was considered the least important factor. Now, just worthwhile mentioning that the actual online survey was done during lockdown. And I think for me, the conclusion that I take from this is that perhaps the realization had already started dawning on people that physical proximity is not as necessary as it once was. That's perhaps my interpretation of it. Anyway, another interesting point for me was that apart from low or zero tax rates, the top criteria for clients seems to talk to simplicity and perhaps a seamless onboarding experience. So if we've got a sympathetic regulatory regime, we can onboard ourselves and we can get bank accounts. That's where we want to be as far as an offshore financial center goes. So this brings me back to the original research questions. So should Jersey's strategy to be an innovation hub for fintechs include attracting crypto asset businesses? And if so, then will this negatively affect Jersey's reputation as a robustly regulated and transparent IFC? Well, the answers to these questions were actually not definitive, but what we do know from the survey and from the interviews is, yes, Jersey is considered to have a good reputation. Yes, it is agreed that an innovation hub strategy can be successful. Yes, generally people agree that crypto assets are a new asset class. Yes, they are likely to disrupt the traditional financial services industry. But yes, they also need the traditional financial service industry for growth and adoption. So despite all of that, there still seems to be some obvious disconnects. The regulators' responses were largely non-committal. The banking sector's responses were out of touch with the other sectors believed. And I got the sense from the free format comments that everybody seems to be waiting for everybody. So 62% of the respondents are interested in keeping up to date, but very few of them are translating that into new products and services. So innovation is lagging in an environment of perhaps reputational uncertainty. So in my somewhat humble analysis, as an island, we have a strategy, but we seem to have varying levels of commitment from the influential stakeholders to that strategy. So my hope is that this morning's discussions, perhaps using some information that I've been able to share with you, will start that process of collaboration, education across all the stakeholders a little bit more purposefully. Because I think that if we do that, then perhaps we can understand crypto assets well enough to reap their benefits, mitigate their risks, and perhaps control how they affect our island's reputation. So that's my piece. I hope it was interesting. I hope it'll spark some questions and some debate. So I'm going to hand back to you, Dave. Thank you.
Thank you very much, Heidi. That was absolutely fantastic, and the sort of thing that we need to kick the day off, which is, you know, some actual results rather than just people's opinions about things, e.g. mine, for example. But I just have to ask, I'm just curious for my own sake, is part of the tension in those results because the conventional, so let's say the traditional banking institutions see crypto assets not as a potential future business of theirs, but actually as an alternative to them? I mean, are they perhaps just a little nervous about this? Where it is an opportunity for them?
I actually disagree with that. I don't think the banks are nervousness about the technology removing them from the landscape. I think for the banks particularly, it's more about the regulation. If it's a little hazy, cross-jurisdictionally, it's not cohesive. And I think if we can nail that down, I think the banks particularly will be more comfortable to support crypto asset businesses with accounts and services, because as you've rightly said, there are plenty of technologies available to help us track the provenance of, identity, all of those. So I think we just need to bring all of that together. And I think if we have not better regulation, but if we have more considered or more bespoke regulation, banks will feel more comfortable, and hence they will help with the adoption and, bringing these sort of asset classes more mainstream.
Thanks very much, Heidi. I really appreciate it. And I think you've illustrated very nicely why we're going to have the first panel of the day around this tension between regulation and innovation, which is really central to the discussion here.
The good thing about Jersey is that it's so small. There's a lot of organisations here that they work more nimbly than places like London. So actually, all of fintech could actually be adopted here far quicker.
Jersey has a big financial services business. We have a lot of people who provide the ancillary service. People who understand compliance, AML, KYC, CTF. That's all in play.
You have a really great test bed for potential innovation in financial services. So it's great to see the interest and enthusiasm from across the industry.
It's important, when we talk about the relationship between regulation and innovation, that we have the right people around the table to discuss it. And that's why I was just so happy that my good friend Rachel Amos from Walkers was able to come here to host today in this new exciting mixed physical and digital. So I'll leave it as an exercise for the reader to determine which of these people are actually here. But if you can make it as seamless as possible, Rachel, I'd really appreciate it. Over to you.
Thank you, Dave. Well, my name is Rachel Amos. I am a lawyer. I'll admit to that right now. I work at Walkers here in Jersey, and I've got a really interesting group of people to help us explore this theme that Heidi has set up for us so beautifully around innovation and the wrestling match with reputation. So just going to ask my panel to introduce themselves, maybe starting with you, Mike.
Morning, everyone. Rachel. Mike Jones. I'm the Director of Policy and Risk at the Jersey Financial Services Commission.
Good morning, Rachel. Good morning, everyone. My name is Mark Cleary. I'm a Director of Zedra in their Fund Solutions and Corporate Services business in the Channel Islands.
Hi, good morning. I'm Chris Griffin. I'm a partner at the law firm of Carey, Olsen, and I head up our fintech practice here, and we've done a lot of fintech and all the crypto in Jersey to date.
Hi, I'm Adam Brown. I'm the fintech lead at Jersey Finance, and Jersey Finance is the sister agency to Digital Jersey. So we represent and promote the island as an international finance centre. So very much to put the fin in fintech.
Thank you all. So I think let's get right in it. How do we, as part of that wider fintech community, help the island manage this conflict that we've just heard, expressed so clearly by Heidi between, and this happens with all new asset classes, and this one in particular is digital assets. But I think, more broadly, if Jersey is to stay with the innovation and the evolution of financial services for new asset classes, how do we, as the Support Act to some extent, assist that? And I think we could get some really good perspectives. You're closer to me, Mike, so I'm going to pick on you. Let's start with the perspective of the regulator.
Everyone always picks on the regulator, don't they? I mean, we've all got a role, haven't we? And it's clearly a balancing act. It's a balance between, the reputation and business growth, and reputation is hard won and easily lost. And as we've heard from a few of the speakers this morning, Jersey does have a very good regulatory reputation. So, we at the regulator we've even got a statutory responsibility in our law and our guiding principles to protect that. And I think what we do is we're going to ask some difficult questions of firms when they're setting up on an ongoing basis. And we tend to find that good firms don't mind being asked those difficult questions. They can answer them. They're happy to answer them. They hope we ask them of the next firm that's setting up, and maybe they can't answer them. So I think we've all got a role, and we expect the gatekeepers as well to play that role.
Right. So sometimes actually regulation can have a competitive edge, as you say. If some people can get through the net and other people's can't, perhaps that's what we want.
Yeah, and the beauty about Jersey's regime is it is quite flexible. We can apply bespoke conditions to a particular firm. So if we ask some difficult questions, it's primarily because we want to understand the product or the service as well as we possibly can, where the compliance risks are, how they can be mitigated against. And if we then answer those and understand those, then we can apply those bespoke conditions, and we can say yes. I guess if we don't get the right answers to those questions, then we can't say yes. So that's where we're coming from. And
it means that the regulator in turn also is learning, which is a great outcome, isn't it?
Absolutely.
And Mark, you're actually at the face of this. You're actually the one who's actually helping, new entrants into the market implement this. What do you think? How do we all contribute to, enabling this in Jersey?
So I definitely think the tension between innovation and reputation is very much a weighing scale. And I would pick out maybe three things. Firstly, I'd say it's incumbent on the industry in Jersey to have, a really good level of competence in digital assets. And I'd make the analogy against maybe trust company businesses having specific licensing requirements for their employees, investment businesses having specific licensing requirements for their employees. I think the digital asset space is new. And there's definitely an element that the industry needs to step up. I wouldn't be against, specific licensing of firms by the Commission, just to have that threshold level of knowledge.
Yeah, and I know. I mean, we chatted about this, and you've sort of taken your own personal journey on that, haven't you?
And no, absolutely. I mean, the second point I would make links to that. I think the industry needs absolute clarity on the rules. It's a bit like if you're driving down the one and it's a big broad road, it's clear, it's nice and easy to do. Sometimes it does feel a little bit like driving down a very narrow lane and it's a bit misty and your lights aren't very good. And that just creates frictions within our business. We have large interdisciplinary teams and we need to find our way through that fog. The third and final sort of thing I think we need to do to balance that is to have, or for the Commission to basically allow some sort of compassion that things will not always go right in this new landscape. And I'd reference FinCEN came out with a paper at the back end of 2018 where they were pushing forward innovation, but that's one side. The other side very much is, regulators need to recognise that things won't always go right, and when they don't go right, they shouldn't be subject to regulatory scrutiny. But I know I understand there's a very, very fine balance between that, because genuinely we want to do the right thing in the industry.
Right, but actually, I mean, that's where some of the other players also play their part. I mean, I'm pulling in Chris at this point, where you've got a client who perhaps isn't driving down the middle of the road. What do you do?
Well, that's a very good question. I think it's worth saying Jersey's probably in about the right place. As Mike said, we haven't introduced lots of blockchain or crypto or fintech specific legislation because doing so is actually quite risky. You put yourself a bit too far out, like other jurisdictions, and I think that's come back to bite them. What we've tried to do, I think, is to fit a new asset class into our existing financial services legislation, and it has been a learning curve. And maybe there's a little bit of extra clarity needed around, if you come and you're doing a security token exchange, should it be this class of financial services business or that class or crypto custody or whatever. But I think having that flexibility is good until such time that there is a global consensus on regulation, because until that time, if Jersey rushes out some regulation, and there isn't really the demand, speaking candidly, for it, then it may come back to harm us. I think the other thing to mention is that Jersey's been actually quite lucky and brave. Jersey approved the regulation of the world's first regulated Bitcoin fund, and that was way back in 2015. And we went on a very iterative, incremental learning journey, both ourselves, the administrators, and the JFSC. And then in 2017, we got lucky. We did an ICO, we did a token launch, and the guy behind that was a highly sophisticated financial services professional, not some bloke trying to make a quick buck out of his bedsit. And so we've had good people come to the island to test our existing regime out. And I think just going back to the point that Mike was making, part of that is industry, the lawyers, the accountants, the administrators, applying a basic sniff test to is this new business, this new fintech business, worth further investigation, or are they just chances on a jurisdiction shopping spree?
Yeah. And so bringing in Adam, how do you get in people who are going to not be too smelly for Chris?
Yeah, thanks for that one. It's ultimately about deciding where the jurisdiction wants to be and the risks it's trying to manage, I guess. And to touch on Chris's point, there's two ways you can enable the innovation. You can decide on the technology and the cluster you want to build, really double down on that and throw resource and create specific policies for specific types of tech or business opportunity. But what if you pick the wrong horse? What if you end up developing Betamax? Where are you then? So I think the better way to create that enabling environment for whether it's digital assets or other pockets of innovation to come out is to look at really 5 core elements, one of which is the regulatory regime and environment, and Mike and Mark have sort of briefly touched on that. The other one is around the digital skills that you have that can understand, that can get it, that can drive forward that product and service innovation. There's also the role of the government through creating and enabling policy. And really then there's the piece around the digital infrastructure, so making sure that the tech is there and it hangs together. And then lastly, it's the incumbent expertise on the island, and that is from the financial services perspective to buy and build, and that is ultimately what we're here for. But ultimately, yeah, you need the other side as well, the tech side, to come forward. So you have both that supply and demand. So that's how I would focus the attention on creating that enabling environment, and whether that's a crypto asset business or otherwise, if you get those things fundamentally right, then you should win out at the end of the day.
Yeah, exactly. Any new asset class, it doesn't, that's really what we're talking about here, creating an environment that's open enough, but also clear enough, where the rules are clear enough, people can have certainty. If you're trying to launch any kind of new business, the last thing you need is a moving target of the regulation or any other rule, any other, how to open a bank account, that sort of thing. So I mean, generally, where do we think the bar should be there? And who sets that bar, and where should it be? Who's responsible? Are we all collectively?
I think we all are. Clearly, government's got a role to set that bar for the jurisdiction. I always think you set the bar where you want to be, and Jersey's always had quite an ambitious stance in relation to financial services, and I don't see why we can't have the same in relation to fintech. I think there's a couple of interesting points that came up. A compassionate regulator, that's an ask. I think the point on clarity of rules, though, is key, and we always find that that's quite an interesting debate, because when you go through the work and you say, well, this is what the rules are going to look like if we're completely clear, then industry doesn't always want those entirely clear rules as well. So it is a balance. What we're going to see, though, is that is changing, and Chris has touched on it, that the FATF has come up with requirements for jurisdictions in relation to virtual asset service providers. Jersey is clearly going to look at that. Jersey, with industry and government and ourselves, will be looking at that quite soon. And you've got as ever, you've got a spectrum of what you do in relation to virtual asset service providers, and will be assessed in relation to international assessments against how we have implemented those requirements. So you could do nothing. You could ban them. We've seen some jurisdictions have done that, and you could have a bespoke virtual asset service providers regime, or you can amend our existing financial services regime. You could have a class of financial services that is a virtual asset service provider. So we'll have to work very closely with industry to get that balance right, but equally we're looking at what the international requirements are as well.
I think that's a really good point, actually, is like, remember, we have to go up. Jersey's in a competitive environment with other similar jurisdictions, but all of those have got these super regulators, really. And we need to be very aware of where we sit kind of in that spectrum as well, because again, a lot of the businesses that we've got here may be operating in more than one jurisdiction. And in fact, when you and I talked about it, and maybe we'll pull this out a little bit, it was talking about actually businesses going from Jersey elsewhere. As well, is a super interesting kind of, how can we enable that? And I don't know what any of you think about that, but for using regulation as a tool, when you come from an environment where it's good, you can then go elsewhere and flourish.
Yeah, there's a lot of good points there. And back when in-person events were a thing, and I'd be off the island, you talk to people and they say, oh, wow, you're from Jersey. That's a really hard place to do business. And they actually meant that as a compliment. It was almost implied that if you can do business in Jersey, whether that's as a financial services business or as a tech business, you are doing something very, very right. Recognition that the regulator is tough but fair. And let's be honest, they need to balance that tension between being friendly and enabling, but ultimately holding the enforcement rules and protecting the island. But the view from outside of Jersey was, there is something very special with Jersey's regulatory regime, but also the way in which we as an industry can also collaborate and enable things. And I think sometimes that's lost when we're looking inwards into the island ourselves.
Interesting. So again, actually, regulation can be competitive advantage if it's done well.
Yeah.
One point I'd make on that is Jersey and a number of regulators, I think there's about 60 worldwide, are part of a global financial innovation network. It's an FCA-led regulatory group, and they have this cohort approach, a bit like the FCA did with their sandbox, but on an international basis. And we had some interest the last year, some cohorts in terms of off-island firms looking to set up in Jersey, but it can go the other way. So we would encourage Jersey-based firms to use that network to get regulated outside of the island.
So I think the bar should be set quite high for VASPs. I think ultimately we will be led by what FATF provide and put out. I was reading quite recently, they've got this new sort of thing called a travel rule, which I think will help greatly in terms of information coming in and going back out. But, you know, I think Jersey needs good quality business. We don't want poor business. So, you know, the rules need to be set, you know, to a high standard, and that's what we want. But then alongside that, we need clarity, how we operate, how we should operate.
Yeah, I'm not sure. Well, I mean, I would say the bar is not necessarily set in any one place forever. My experience of this asset class and people who ring me up and people who I've met at the same sort of conferences Adam has gone to, you know, selling Jersey is, you know, fintech is a startup asset class. They don't have that, you know, they're not Goldman Sachs, they're not JP Morgan. They are a bit short on money quite a lot of the time and spending a huge amount of working capital on regulatory compliance is quite a tough sell. That's not to say they shouldn't do it, but there are other jurisdictions out there that say, look, we'll let a few small businesses in, they may succeed, they may fail. And if they fail, it doesn't really matter because they haven't got much of a client reach. There's no regulatory taint about which we're all obviously very concerned. If and when this asset class becomes more mainstream, then at that point, there is an argument that at that point you raise the bar a bit. You say, well, we allowed in a few of these small players just to start with, so that all, you know, the regulator, the service providers, the lawyers, the accountants could all cut their teeth. And then we know what we're doing, so that as and when Goldman, JP Morgan, Deutsche, whoever it is, comes and knocks on the door, we know what we're doing. And we then, at that point, as a financial services jurisdiction, shut the door a bit more or make it a little bit harder for the startups.
Interesting. Any takers?
I think startups don't necessarily need to have a lot of wealth behind them, but they need to come with the right attitude. And they need to come with a mindset that they're going to, you know, wholly comply with the local rules and regulations and legislation, and that is an investment of time more than money necessarily. And you know, we're absolutely willing to talk to service providers of that mindset. And then yes, we play a part as well, and the guys sitting around me play a part. But there's definitely an educational, as well as taking somebody on as a client, there's an educational piece that we have to go through with them and bring them on a journey. So yeah, it's in that respect, I think that we need high standards in Jersey, and ultimately I think we will be led by what FATF does put out.
I think from our side, I completely agree. The sort of compete on quality is our model. If you compete on, you know, cost, reputation, speed, someone's always going to undercut you. So compete on quality is what we've decided to do. But then taking both Mark and Chris's point, you know, we're not a zero failure regime either. Firms are going to fail for very sound business reasons. It happens all the time, and you know, we're not in the business of saying, you know, we're going to assess that part of your business model. Where we all get interested is if there's a failure for compliance reasons or fraud or something like that, and there's, you know, retail money. And I think Chris is right, the bar is moving all the time. We've even seen it sort of goes up and down in the UK with the FCA sort of retail crypto stance recently. So I think we just need to keep a constant eye on it.
Yeah. So actually, let's talk about failure, because we want people to come and fail, don't we? We want innovation is fundamentally about trying new things, trying and sometimes failing. And I know there's a whole kind of fail fast, but actually, fail, perhaps safely fail in a way that you could then, stand up and do it again. So how do we encourage people to come and innovate in a way where that isn't terminal? They've got to be able to, because that actually will promote innovation. And I know it's not something that normally people like us talk about, but I think that's really interesting. How can we create an environment where that's possible?
I'm not sure we design it so they fail.
We haven't
we have
got
to allow it.
We don't have a formal sandbox here, unlike the FCA. Now, the experience I've heard about from my colleagues in the UK is sandbox is all very well, but if you want to move out of the sandbox and get into the get fully authorized status, it's like chalk and cheese. Sandbox guys all know what they're doing at the FCA, and you go to main authorizations, and you might as well be talking Swahili. Here, one of the great things about Jersey is that it's a small place, so you can move quite quickly, and we've moved quite quickly on previous fintech ventures, and we've had quite quick responses from the regulator. Given the sort of fluidity of communication, the quick responses, and the fact that, as Mike said earlier, there's a ability to impose bespoke conditions on regulated companies. Instead of having a formal sandbox approach, which everybody trumpets, but everybody goes in there, seems to wallow around in there and never get out into the big wide world. Maybe you look at bespoking conditions of operations. You put them on their COBO, on their regulatory certificate.
That's interesting.
And that just allows a little bit of flexibility as to what embryonic companies are able to do, both in terms of the size and nature of their customer base.
I kind of agree with that. I think companies coming to Jersey maybe on some sort of a pilot scheme may work. I think failure in itself is nothing we should shy away from. The issue is always failure when investors or customers lose money that they shouldn't have lost because the controls haven't been strong enough. So even coming to Jersey on a pilot type of program, you're still going to need good, strong governance around what those type companies do ultimately. But yeah, if they could go into some sort of a pilot, then I wouldn't object to that at all.
Yeah, I think, and I need to be careful what I say in a tech environment for fear that they won't let me out of the building, but I don't really buy the move fast and break things technology mantra that comes out when you apply that through the context of financial services, because there's ultimately a client or a person at the end that is either not having their wealth or their asset managed appropriately, or the risk for the business isn't being managed. So I think we need to balance the reality of what providing a financial services to a client actually means, but that's not to say that we can't have appropriate structures to mitigate the quantum of risk. So the type of business that we attract to the island, well, it isn't always the retail type of client. It's sophisticated investors that are aware of these things, that understand their obligations, that should know what they're getting into. They're seeking the appropriate advice from high quality people and businesses such as everyone on this panel, and I'll include the regulator in that does have that come and speak to us approach. So you don't necessarily need to fail if you've got other things in place as well. I think we sometimes just need to change the way we look at the thing.
I've always thought that a sandbox is, this might be controversial, but it's just marketing, really. I don't think we need a sandbox because, we've got a flexible regime. It's proportionate. We can offer trials, limited number of clients, all of these through bespoke conditions. So I've never felt that we've needed a sandbox. We have an innovation hub, and I think we'll hear from Alenka Appley, who's our fintech lead later on this afternoon, who runs that. And it's for the exact approach that's been outlined, that if you're not sure, do I need to go to our formal authorization team, or do I need to go to our company's registry, and I've never been regulated before, how does it work? Just speak to somebody. You speak to Alenka, she'll tell you the regime, what works. Looks like you might need to get a lawyer on that one, or actually looks like you won't be regulated on this one. It's effectively a free bit of counsel that we offer, and then ultimately you have to go one of the routes. Yeah. But it's that's already available.
So that sort of brings us back around to, as a community, because Jersey is a small place, that we have that benefit, that you've got those cross currents, you can have those discussions. Maybe we'll just wrap up and talk about the banks. Why not? They're not here. So Heidi's presentation was interesting, talking about some of the responses that came back and the difficulties, that some of these digital asset providers are having, and the sort of theme about the negativity from the point of view of the banks. But I wonder if, underneath that is actually the struggle that all big global, banks are having around the kind of AML, all of that heavyweight stuff that they have to do, and just sort of touching again on what Dave said earlier about digital identity and that kind of thing. I mean, where do you think, just give me a forecast for Jersey. Where's Jersey going to come out on this, do you think?
It's a tricky. It's always good to pick on the banks, not the regulator. So yeah. Absolutely happy to talk about that. I think from our perspective, it's a challenge. The whole sort of KYC utility. We put out a report earlier this year, sort of giving our views, and people are expecting the banks to do it, or government to do it, or the regulator to do it. And our position is, we support it. We think it's a great idea. We're happy to be involved, but it's not our role to build it. Somebody's got to lead it. We'll be involved in that. And equally, we're not going to endorse somebody who does it. That's not what we do. For the banks, it's difficult. They've got de-risking pressure. They've got group head office pressure. I've got some sympathy for their position.
So I think with the advent of central bank digital currencies, the banks will eventually move, but that's some way off. But look, I fully understand their position. Coming out of the financial crisis, they lost a lot of trust. They've been heavily fined for various money laundering scandals. My perspective is, why would they particularly want to take on, a digital asset business and provide banking to them when they're exposing themselves? So, if they can do that in the knowledge that it's an innovative technologies that they're moving into, and the regulator can maybe lighten up a little bit on that in that pilot period, then I think they might move.
I think it's quite easy to blame the banks. I mean, the banks in Jersey are all subsidiaries or branches or affiliated in some way to the big UK and global banks, and so they're always going to follow the lead from head office. And until such time as head office gives them the thumbs up, the local banks here are always going to say no. So that sort of begs the question, would Jersey be open to the opportunity of a sort of a challenger bank setting up standalone, a fintech crypto orientated bank? I mean, we've had a few inquiries, but nothing concrete yet. But it's something that, to break the banking impasse, that's probably the quickest solution. But I think it's wrong to blame the banks for any perceived lack of fintech innovation in Jersey. I mean, we've got plenty of businesses that are based in Jersey who just bank elsewhere.
Yeah, full disclosure, as a former banker myself, I completely get and I sympathise with the points already made, but there are still pockets of friction, and I think what we need to be clear about is, what is the ask of the banks? So I've heard stories about a crypto consultancy person that cannot get an operational bank account because they advise on crypto. That is not saying the person is dealing with crypto, but because it has the word crypto in their business, it is a de facto no. So I think we're not helping ourselves in that regard when we're turning down good business. And I get from the bank's perspective, what's the value in exchanges? Because the money isn't sitting with the banks. They're being asked to police the on and off ramps with the whole AML piece, but they're not earning the interest carry from it. So I can see why that wouldn't be an attractive proposition. But then if you look at cryptocurrencies or digital currencies, digital assets, as an alternative asset class in itself, there's a tremendous opportunity there because Jersey does funds well. We do alternative asset classes, be it real estate, private equity, hedge. Why isn't digital assets in that bracket? And there's work to do to bring people up to that curve.
Shall I tell you why? Because
Please do.
Because crypto and blockchain is all about the democratization of financial markets. So historically, we tell the young to invest. They want to go and buy shares in companies they use, like Amazon and Google. I think Amazon's trading at about $1,700 for one share. If, however, you use blockchain to slice and dice traditional financial instruments, equities, debt instruments, all the rest of it, they become much more widely available to the young and to the retail public. Is that something that Jersey, which historically has set its stall out as a sort of sophisticated investor jurisdiction, is that something that Jersey philosophically is really ready for?
That's a fair point, and you add in securitization on top of that when you're unlocking those traditionally locked up and illiquid asset classes. It's a fair point.
And that brings us full circle to reputational risk, doesn't it?
Yeah.
Fantastic. Well, thank you very much for that. Excellent segue, Rachel. I really appreciate it. And thank you very much to all of the panelists for giving us such honest and informed perspectives on such an interesting topic. I really appreciate it. Thank you so much. The mention of digital currency was greatly appreciated because that's going to be the subject of the next panel.
Given Jersey is a very traditional, has the right pedigree and has great reputation for the financial side of things, everything to do with financial technology will be relevant.
Jersey Finance and Digital Jersey have been working very closely on the fintech agenda and on the development of the fintech roadmap. And of course, that's something that makes absolute sense, given that it's very much an area that brings together the financial services sector with the tech community.
And I think you have a really fantastic microcosm here in Jersey of financial services and a lot of appetite for innovation, it seems.
Well, as has been mentioned a couple of times this morning already, one thing that's very different over the last year has been the emergence of digital currency as a serious topic. I mean, no longer the subject of sort of science fiction speculation, but a topic of serious study and investigation from central banks. And if you look at some of the work that's been coming out of, not just the Bank of England and other people that I regard as sort of leaders in that field, but banks all around the world, and indeed the Bank of International Settlements, you see that there's something really interesting going on. So I'm delighted to say I managed to get people from all over the world to come and join us this morning for our virtual panel on digital currency. I'd like to welcome you all here. Ben, Simon, Peter, it's just fantastic that you could join us this morning. I'm just going to ask you very quickly to introduce yourselves to everybody, and then we'll get into the meat of the discussion. So, Ben, if you could just sort of say a few words about who you are and what your interest in digital currency is.
Hi, Dave. I'm Ben Dyson. I work at the Bank for International Settlements Innovation Hub in Singapore, looking at issues around digital identity and cross-border payments. Before that, I was at the Bank of England, working on CBC.
And actually, before that, you were also interested in the subject of digital money. I mean, let's be honest, going back 20 years or.
Not
okay,
that long.
I won't say that, but yes, long time. Simon.
Hi, good morning, Dave. Good to see you. I'm a business engineer with a technology background, so I'm an educated business engineer. Started out at the Post Bank, introduced a small e-money currency chip knip as a part of the process, moved on to the central bank to be a supervisor on electronic money, and I witnessed the development of the e-money directives in Europe. This is about around 2000. Moved into consulting on innovation and fintech, and then I stuck with one of my clients, which was the Dutch Bankers Association, Spent some 7 years there, including the financial crisis. And when that was sort of over, I moved on to be an independent consultant, and I'm advising fintech, crypto players, and all payment service providers, e-money issuers on regulation, what's happening in the space, and all that stuff. So I'm sort of a dinosaur in the e-money area.
Well, I won't embarrass either of us by saying how long it is. I mean, it's been many years. You've been my go-to person on electronic money in Europe, Simon. So thank you very much for joining us here today. Peter.
Hi, how are you doing? Peter DeMeo with IBM, and I'm actually kind of really a different bird. I'm responsible for digital asset confidential computing at IBM. So I'm all in the private key management part of the world, secure hardware, trusted computing, enclave technology, those kinds of things.
Thank you so much for joining us today, Peter. I really appreciate it. We'll come back to some of my crackpot theories linking digital currency and digital assets a bit later on. But I want to start with a couple more general questions, because I think some of the people sitting in on this are going to wonder why it is exactly people like us are talking about digital currency at all. I mean, never mind so excitedly. So if I could just ask you to first of all think about what is it that's happened in recent times to actually put this on the agenda. I mean, what's the difference with digital currency now? I mean, Bitcoin's been around for God knows how many years. I know no sane person would use Bitcoin as digital currency, but the point of the topic's been around for many years. But guys, why is it talking about it now? Anyone?
Well, I think so Bitcoin did start a lot of this conversation, and it was there was a kind of discussion in central banks around, is this going to be a threat to cash or to what central banks do? And I think they concluded pretty quickly, actually, this won't be a threat to national currencies overall, but there are interesting questions about whether you could adapt and use some of this technology to improve payments. And in particular, the way that some of those underlying technological innovations have then been adapted into things like distributed ledger technology. And that's generated a lot of interest in, are there different ways of providing payment systems? Are there ways of improving the experience that the end user gets? I think where central banks are at the moment is not so much saying, this is just DLT. This is not just national currency on DLT, but it might be a kind of broader question about, given the technology that we have today, DLT and everything else, is there a better way to provide national currency to the public?
And is it fair to say that you made a very quick distinction there, which I think is important. So there's a difference between using cryptocurrencies to create central bank digital currencies and using cryptocurrency technology, right? I mean, that's the distinction you were making. Peter, what are those key cryptocurrency technologies that might come into play in creating this new digital asset infrastructure?
Well, I think first of all, there's quite a bit actually. What would be the structure of a central bank digital currency? If we think about how DCEP in China is structured, there's actually two parts. There is the sort of the central bank level, and then there's also going to be, or there is, if you will, the commercial bank level. And this is two sort of structured, can be implemented using the same, many different ways, but it could be using the same blockchain or DLT technology, most likely some permissioned form of chain. And then from there, you can think about it. Well, I have a lot of trade-offs between, let's say, privacy, confidentiality of transactions, in my case, secure computing hardware, and how do you look after individual user keys? There's a lot of, from a technology perspective, there's a lot involved here. Identity privacy, for example. Can we show that? Can we link transactions to a particular sender or recipient, or transaction privacy? Can we can we learn, anything about the nature of the transaction, like perhaps where it's going from? Did Alice, send $40 to go to the pharmacy? Yeah. And is that important?
We'll come back to the privacy stuff a bit later on. I just want to get a shared understanding of the technologies first. So Simon, is this a great generalization, or is it fair to say we basically only have one choice there, which is do we essentially implement using hardware or software? And in Europe, a few years ago, we tried it with hardware, and it didn't really work, did it?
Well, indeed, we had this so-called chip-knip IC chip-based electronic money, which dates back from the day and time that telecommunications prices were very high. So everyone was looking for an offline version of electronic cash to do it quite cheaply. And basically, the product blew up in the face when the telco providers started lowering their fees, and we entered the online always world. So that's where the hardware-based e-money in Europe disappeared, and I think it's about right about that time that also Mervyn King did this famous speech in Jackson Hole, saying, "Well, we should understand central banks may disappear if indeed private companies start issuing their own forms of currencies." So conceptually, you could date the whole electronic cash discussion back at least to 1999 in its sort of prediction of because Facebook didn't exist, but he was already talking about platform-based worldwide companies issuing their own private currencies. Well, so that's the older where it came from. So.
Yeah, I just want to be a little clearer before. I mean, none of us are against wiping out central banks, obviously, but if we can just leave that to a bit later in the conversation, I just wanted to make sure we're just really clear on this technological issue. What we're talking about is, so I'll illustrate it. I'll ask you guys another way. So Mark Zuckerberg said recently he wants to make sending money around the internet as easy as sending a photo around the internet. And the reason why that's difficult is because when I send you a photo, I'm not really sending you the photo, I'm sending you a copy of the photo, which is fine for photos, but not so good for money. So what we're really talking about is we're going to start sending money around the internet. We have to stop that copying, the so-called double spending problem. We tried fixing that in hardware, and ultimately it didn't really go anywhere. Now we have to fix it in software using some of these technologies that have been discussed, distributed ledgers and all this sort of thing. So kind of what I want to know is, is this just going to go the same way as it did before? It's a bit of a fad, everyone gets excited about it, and then it goes away again. Or is there something different going on here? Why are, the Bank of International Settlements, the Bank of England, the Bank de France, the Bank of Sweden, what's different this time, which makes us all think that digital currency is really going to happen this time? Is it just technologists getting carried away? Peter?
Oh, okay, yeah. I mean, just think of some policy levers that you have with digital currency. For example, if you're a central bank, you can actually do negative nominal interest rates. You can create currencies with various rules and spending conditions attached. You can go ahead and even issue non-fungible asset class types that, for example, apply in just specific instances. Like let's take food stamps in the U.S. Only certain providers, if you will, should have access. Food retailers, if you will, should have access to that particular type of non-fungible currency. And then the rules with respect to providing those back to the people receiving food stamps, for example, the rules associated with enabling those or maybe, pulling them back, and which kind of takes you to the next point, which is really around, the difference fundamentally, I think, is that you have the ability to actually create conditional logic around the use of digital currency, which is, via either smart contracts or some other mechanism. But that didn't exist before, right? And so I think that fundamentally changes the nature of the discussion.
Ben, if I remember correctly, the Bank of England's sort of original thinking about this, they sort of split the benefits into two parts. There was the sort of cost-saving stuff that comes from having digital currencies, and saving money on physical cash transport and security and that sort of thing. But as I recall, the bigger part of the business case was what Peter's referred to, which is sort of programmable money and currency as a platform for innovation. Is that the BIS's interest?
Yeah, I think it's so this is not firstly, this is not a kind of attempt to replace cash. There are people who need to use cash, people who rely on it. And actually, when we worked this through, we didn't really think a central bank digital currency would have a big impact on the level of cash usage anyway. So the benefits really come from where does this improve your existing payment systems? Where does it provide additional functionality? And there's some benefits for kind of end users, people in shops, if this provides electronic payments at lower cost. If it's more inclusive than some of the existing payment systems, so if you can use it, particularly in an international context, to provide digital accounts to people who don't have access to banking services. And then in a kind of more wholesale financial markets context, does this provide functionality like programmable money, and these kind of use cases where you can tie money together with for example, contracts, so that certain things are automated or dependent on external events, which you can't do with some current payment systems. And part of the thing about innovation is it's hard to know what's going to emerge from that.
Yeah,
so
yeah,
there's
exactly,
yeah, potential, but it's not clear what the killer use case would be.
So the idea of having, I mean, again, it's a ridiculous paraphrase, but the idea of having money that has an API, cash that you can call in a subroutine, essentially, like if that's there, we don't know what people will do with that, but it's a reasonable bet people will do some amazing stuff with it. I think that's a summary. So if we think about it, so we have the technology we didn't have before. We have central banks who see it as an opportunity for, you know, some tools in a toolkit that they didn't have before. Those two things come together to make this a reality. This isn't just idle speculation, is it, Simon? This is something that's actually going to happen.
It's certainly going to happen. You can see the economic circumstances and drivers being quite different. There's really let's say competition in the central banking space between the US, the Chinese, and the European Central Bank on the issuance of a digital currency. But most of all, there are very important big tech platforms with the ability to do electronic money or electronic cash, and to have a huge power base and user base. And this can completely disrupt the monetary stability if they start doing this on a big scale, and particularly if they start introducing their own unit of account and creating their own campus-like environment where everything happens on the big platform. And that's where the drivers are and the incentives are for central banks to provide a public alternative to private currencies. And there needs to be this, you can debate about whether central banks should step into this private market or whether private companies should step into this public market. But we need a stable form of electronic cash, which is inclusive, which does not control or do surveillance, but does the job that cash does right now. And that's what we really need. And that's where central banks have a huge legacy to fulfill in their digital version of cash.
Okay, so now you're taking us away from the nice, fun, fluffy stuff about how isn't innovation cool and all that sort of thing, into some of the serious stuff, which is, I don't think people have really thought through what I mean, you have, because you guys think about this. I mean, people in general are underestimating what the impact of digital currency will actually be for several reasons. One of them is the ability of digital currency to project soft power, which, I mean, I don't want to make any political comments about that, but it's obviously true. Another is the ability of digital currency to bypass existing infrastructure. So if I can start to push you guys, let me put it this way. I have a wallet and I can store, let's say, Chinese digital currency in the wallet. And then I buy some things from a supplier and they have a wallet where they can store Chinese digital currency. So in this future world of digital asset platforms, the Chinese digital currency just goes from my wallet directly to their wallet. So if that's true, if that's a vision of the world to come, what exactly will banks do? What exactly would SWIFT do? What exactly would all of these other international institutions do? And more importantly, what could Jersey do to take advantage of that situation? So let me ask you guys that tough question. If you're right, if digital currency is coming along, What are banks going to do? What is SWIFT going to do? What are the institutions going to do? Ben, I don't want to put you on the spot, but I know you've thought about this stuff.
Yeah, so when we talked about this at the Bank of England, and we thought that the appropriate thing for the central bank to do is focus on the kind of core infrastructure and the underlying payment system, and to leave the, provide the platform for the innovation, but leave that innovation to the private sector. So it's not that it's replacing all banks, payment providers, and Visa and MasterCard. It's infrastructure that they can build on top of. So I think there's still a lot of opportunity there. As I said before, this is kind of innovation, so it's not clear exactly what payment systems will look like in 5 or 10 years from now. The idea is just to provide that platform and allow that innovation to take place.
Simon, I think you come from the more radical end of the spectrum here, don't you? I mean, I think, and I have a suspicion that some of the things that you've been saying are right. This is a much bigger change than people think, isn't it?
I think it is indeed. But if I were to go back to your question, what can Jersey do? I think what the people in Jersey can do, I listened to the previous panel with a lot of interest. I think the next regulation, crypto assets, also has a link towards e-money, the electronic cash, and how you regulate it. And we have a danger in the upcoming MiCA regulation that the definitions are pretty flawed, so that good, stable regime of e-money issuance is going to be, converted into crypto assets, or crypto assets are going to be defined as e-money, and you don't want that. You want to keep the e-money regime intact. You want to use it because internationally, if you look at cryptocurrencies, Kraken in the US, the big crypto provider, has chosen for a specific financial institution regime, which is actually a copy-paste of our first e-money regime in Europe. And this is really a very valuable starting point for anyone starting with digital assets. You can start with e-money on the safe side of the banking picture, do the right stuff, and use that as the half of your platform, with the other half being cryptocurrencies to be dealt with. And then once the MiCA regulation comes in, the European regulations on crypto assets, you can make sure that your company does the crypto side as properly as it does the e-money side. And I think there's really a stepping stone for Jersey to take by making sure you get the e-money providers and making sure you create a smooth transition towards the future EU regulation on crypto assets. And that's where they can certainly make a difference in aligning, perhaps even being a bridge between US and the EU, as it were. But that would be my hunch on your question.
I think, thank you, Simon. I mean, I think you're absolutely right about that. And a well-regulated crypto asset market would inevitably end up supporting those kind of central bank digital currencies, because you'd have to have a strong suspicion that when the central bank digital currencies are implemented at population scale, they won't be implemented as conventional electronic money, and they won't be implemented as cryptocurrency. They were, as Peter alluded at the beginning, they'll almost certainly be issued as just a particular kind of digital asset sitting on a more generalized digital asset platform, right? Albeit one that can have high transaction rates. So, actually, transaction rates make me think of something else, Peter. So, if we're going to have central bank digital currency, that's got to handle hundreds of thousands of transactions per second, right? So, is the technology capable of doing that, or are we jumping ahead of ourselves a bit here?
Well, I would say that we are not there yet for DLTs. You have companies that are approaching or trying to at least claim they're approaching the transaction volumes of the major credit cards out there. But I work for IBM, and there's Visa, MasterCard, American Express. Those are our clients, and we have a good idea about really what's involved with those kind of transaction rates. So it's certainly possible. But then again, if you have to what degree do you do smart contracts, and what degree do you involve conditional logic, and do you actually have a bifurcated structure where it's like there's the central bank part, and then there's going to be the payment interface providers from the Bank of England, or some other layer more in the commercial retail bank side, and how's that all going to work? That all takes time.
That's a fair point. I think one of the attractions of the Bank of England's proposed PIP, payment interface provider architecture, though, is that I think the Bank of England's implicit assumption is that the smart, I mean, they're not smart, contracts, they're not contracts, but let's skip over that. That stuff will be handled at the PIP level, right? Not is that right, Ben? I mean, I'm assuming this is the kind of hybrid that the Bank of England's edging towards.
I think there's a question with this kind of smart contract functionality, about how much do you provide in the central infrastructure and how much do you leave to the private sector? If you look at some of the, Ethereum has it all built into the core infrastructure, and that has some pros, but it also has some, kind of high profile weaknesses. So there's, rather than necessarily adopting one smart contract standard at the beginning, it might be better to leave some of that to the payment interface providers or other players.
Okay, so and actually, I mean, I guess I'm arguing against myself here, but we can already see people like Alipay are already up at the sort of 240, 250,000 transaction a second level. So the idea that you can't implement is clearly ridiculous because they already have done. And I think it's also fair to allude to the fact, as Peter said at the beginning, China has opted for that two-tier implementation where the central bank sort of controls the digital currency, but it's actually the commercial banks that put it into people's wallets. And I mean, that seems to me like that will become the standard way of doing things, which then brings the sort of my last topic. And I know it's the kind of emotive topic, but I think for the people watching, it's fair to say this is controversial, but has to be thought about. You've mentioned a couple of times, you guys, about privacy and surveillance. And there's no denying the fact that something needs to be resolved here. If we're going to use digital currency as an emulation of physical cash, that will mean anonymity. And from the outside, you guys, I hope, know better than I do. I cannot see any possibility of any regulator in any jurisdiction allowing any form of anonymity at all. Is that me being too conservative, or is that a realistic reflection of where we're going? Simon?
I think it's a realistic reflection, but I would also call upon the regulators to read their history books better.
What do you mean by
that? You need to have a robust society, not just a robust financial system where you think you can catch crooks by deleting all privacy. You need to have a society which is so robust that it doesn't matter if there's anonymous money. And if we build a society on the assumption that there may not be anonymous money, we are building a very scary society where everyone can be controlled by smart contracts. So we need to rethink our positioning. We need to think about robust societies. Robust societies have no problem catching criminals. They don't need FATF travel rules. They just need good policing and use of technology to catch the crooks as the police. And we must skip all the anti-money laundering stuff, which are privacy invasions in their own right. So we have to rethink this one very properly. If we're taking a next step in terms of technology, we must also take a next step in terms of philosophy underlying our AML structures. And the old broadcasting data philosophy from the 2000s, early 2000s, is outdated. So we should skip it and replace it with a pool information request for law enforcement rather than sending out all data to everyone in the world.
I think, and am I interpreting this correctly, that actually the discussion about privacy and anonymity in digital currencies really shouldn't be restricted to technologists like me or Peter messing around with keys and things, and it shouldn't be central banks either. This is a much bigger discussion, isn't it, for all of society to get involved with? But how do we make that happen?
Yeah, it absolutely is. It's not just a anti-money laundering question, right? This is, there is a difference between privacy and anonymity, and you don't necessarily have to replicate cash perfectly. But then with that privacy question, there's questions about how much data has to be shared, who should have access to it, and it goes beyond payments as well. It's, everything that is happening today with big data and big tech. So yeah, it's not just for the technologists, it's not just for the central banks. That's kind of a wider societal debate to be had, I think.
But Pete, technologically, we can set the dial anywhere, right? So if people say to you, we want a currency that's completely anonymous or completely not anonymous, we have the technology to build either of those, right? So whatever society decides, you technologists can deliver it. That's not the problem, is it? The problem is getting society to decide it.
Yeah, I would agree with that. I mean, I just want to go back to the point about anonymous person-to-person or person-to-business transfers. And you had mentioned Alipay earlier. Alipay had filed a patent called controllable anonymity, which basically is an anonymity for user-to-user transactions. And my understanding at the DSAP, that's actually been employed at the user level. So person-to-person transactions via QR code and so forth. In fact, even done offline, because every single DSAP coin, if you will, has been serialized. You can actually have transactions done offline, person-to-person, completely anonymous. Okay, but the buts part of this is, however, that whilst the users have some degree of anonymity with respect to other users, the banks have the mechanism to de-anonymize suspicious transactions. Obviously the whole AML and counterterrorism as well, and quite frankly, I also believe a good bit of analytics on the back of that.
Well, look, guys, thank you very much for this introduction to the topic. I'm sure that digital currency is going to be one of the key topics of the coming year, and it's important, I think, that all jurisdictions begin some intelligent reflection about the topic and try to work out what it is that we want from it. So I just really appreciate you introducing the audience to the key parts of this important discussion. Thank you very much. I really appreciate it.
Thank you.
Now we're going to move on to the last talk. I said earlier on that when we talk about the technologies and what's going on, we tend to use the word fintech all the time for everything. But as you have picked up from some of the comments that I made and other people have made about digital identity and so on, there's actually another thing going on here, which is what you might call regtech, which is using technology to reduce the overall cost of financial intermediation in a jurisdiction while maintaining the same levels of security and transparency, all the other things that we think are important. So there's a big argument that says for somewhere like Jersey, what's going on in regtech is just as important, perhaps even more important, than what's going on in fintech. So it was just really great that we were able to finish the morning by listening to someone who has built a great company in this space, someone whose opinions I take really seriously about this sort of thing. And it's my good friend Charles Delling-Pole from Comply Advantage. So please, Charles, over to you. Thank you very much for joining us.
Awesome. Thanks a lot for the very kind intro and great to be here today. And a great discussion just now. A great honour to be able to finish the presentation today. Shall I dive in? Or?
Please take it away.
Yeah, so I think as you said, regtech is probably the most important and interesting dimension of tech, particularly as it applies to the discussion that we just had. I think Simon and Peter had some great comments there around how the philosophy around AML was outdated, and then Peter was saying about how fintech would definitely evolve. And I think particularly in the light of things like the Panama Papers and Mossack Fonseca, we can see how some jurisdictions, particularly jurisdictions similar to Jersey, could be under huge threat if regulation is not adequately maintained and developed. And therefore today I've got kind of just 13 minutes left to kind of give a brief whirlwind tour of the exciting area of regtech. So I guess just as a kind of brief overview, I think what I'll probably start by saying is there are hundreds of companies in this space. There's been a kind of Cambrian explosion, and this gives a kind of very broad overview. I think, as you said, it's a very interesting space. Like, lots of the companies have nothing in common with each other beyond the fact that they're designed to help force companies to do what they otherwise would not do. If you're a credit firm, then perhaps you don't want to go to 100 times leverage. If you're a identity firm, then perhaps you prefer not to do any IDV at all on your crypto clients. But then the FBI will come and begin to shut you down. So I think I think that the only kind of common factor underpinning all these companies is they help you to do things which regulators want you to do and which otherwise participants in the market would simply abandon. So I guess in terms of background context, as you point out, I've got one particular specialism in this area, which is money laundering. So I started a company doing lending, and there I was kind of shocked to find out that I'd be myself sent to jail if something went wrong. So I guess in terms of the reg tech focus, probably the biggest space that kind of underpins all this, and probably the most relevance given the agenda today, is this area of money laundering. So I think in terms of the relevance there, if you look at every fintech company, every payments company, the common threat is they can move money around globally, and that's resulted in fines. And as you said today, lots of interjurisdictional competition with regards to a potential race to the bottom. As you see with things like the FATF blacklist and the EU blacklist, and attempted addition of the new blacklist last year, adding places like Saudi Arabia to that from the EU, it's a huge consequence when we move into how payments and fintechs are able to interact. The common underlying thread is that it's becoming far more challenging as time goes on in terms of the complexity and risk. So what this means is entities like cartels, gang members are using every type of mechanism possible to try and launder the proceeds of different types of precedent crimes. So you see is all kinds of data points every day, new pieces of information going onto the internet, new identities, new forms of global money transfers and payment flows, entities like Alipay, which are able to shift all over the world, and entities like Jersey trying to counteract this massive flood of different forms of crime. And therefore, what we need is some technology, because people alone aren't able to counteract that. So what we see there, therefore, is, at least for us, an attempt to work with all kinds of clients. So in the past 6 years, we've been working with all kinds of companies, from Visa to all kinds of crypto companies and large banks, insurance companies. We personally operate in 80 plus jurisdictions. We've raised $100 million. So this kind of leads us to interact with all kinds of reg tech firms and fintech firms in the industry. So I guess the underlying common theme that all these different entities have is the use of technology. So I think perhaps the biggest, most hyped area of that is the ability to use different forms of machine learning. So you have the cloud, you have AWS, you have all kinds of natural language processing systems, and therefore, at least to me, the thing that felt the most telling to me was that rather than using hundreds of analysts to try and shift through billions of entities in terms of people and companies, it was possible to use the algorithms developed to try and shift through these. And therefore, what we're able to do is ingest tens of millions of web pages a day, and then be able to understand from those web pages which of them contain a threat and which of them don't contain a threat. So if it's Ronaldo terrorized the defense, then that's fine. If it's Ronaldo terrorist attack, that's not fine. So what this means is a whole new way of solutions have developed off the back of different forms of machine learning to try and address these issues. And that can be in terms of the ability of machine learning to use true positives to detect fraud, or different forms of computer vision to understand which identities are correct. So at least for me, the underlying technologies that are available beforehand were very antiquated, and lots of banks have within their systems some very old problematic systems which have led to huge costs. And this has been a huge weapon that fintech companies and non-legacy financial companies have used to be able to gain massive scale, reduce their costs, and grow without the kind of same level of fines that we've seen with companies like Deutsche Bank. Deutsche Bank was fined, I think, a few $100 million last month for sending money to Jeffrey Epstein, who obviously was shipping humans and child prostitutes over different borders. So that's obviously a very bad thing. So therefore, in terms of the kind of broader wave of RegTech companies, we see an underlying shift in terms of the number of different challenges they face and the solutions. So therefore, for us, what we try to build is this 8 billion people and how many billion companies all connected via a large automatic knowledge graph. I think in terms of corruption, bribery, in terms of the Mossack Fonseca scandal, a huge problem is it isn't necessarily the person that's applying to use an account that could be the problem. It could be a relative and known associate. So therefore, in this example, what we're showing is that, say, if you're Barack Obama and you're using your brother in Kenya, Barry Obama, to be able to understand a huge web of relationships. So what we've seen previously is Nigerian generals like Sonia Abacha who will steal vast amounts of money, exfiltrate that into banks, have that washed around, or Mexican drug cartel. So I think the real challenge for jurisdictions, particularly in an era of jurisdictional competition, is not to be tainted by bad money, and therefore use of money mules and use of known associates. I think Putin's violinist is known to be a billionaire, even though all he's done is play the violin. So we can see every entity in the world being potentially at risk, even without a real track record history of being a victim of money laundering. So, and therefore, the approach is, rather than simply being captive to a certain language or jurisdiction, or being limited by the ability of a human to read a certain number of articles per day or ingest data, is with the explosion of information is the ability to read everything and kind of approach some level of omniscience. And that's part of, at least for us, the ability to harness technology to solve kind of key regulatory challenges. So I've only got 5 minutes left before the conference and my talk finishes. So I'm going to go on to actually how this helps companies in practice. So I think the exciting thing about having all data available in a vast data lake, rather than kind of side databases, is being able to spot the hidden connections. As in, if there's a data point from the FBI responsive list, that can then be used to link to a corporate registry or to another data point in a different data silo, which would then allow you to see risks, because the underlying challenge we're trying to achieve is to solve the problem of terrorist financing and money laundering, such that different regulations and jurisdictions can be able to more effectively interact rather than being a very strong countervailing force to globalization. So I think in terms of the scale and the ability to understand all the types of risk, I think if you look at the kind of sheer range of precedent crimes, so the fifth EU money laundering directive, and also the recent FATF taxonomy, has shown that there isn't simply one type of crime. What we're looking at is a huge spectrum of crimes and risks, and that isn't simply around narcotics, a cybercrime. It's also around different forms of non-violent crime or late payment to creditors. Or so I think in terms of regulations often relate to the sheer numbers of risks we face, and therefore, if a company or jurisdiction wants to avoid reputational damage or fines, I think the only possible solution is better forms of regulatory technology. So in terms of, at least for us, there's a huge range of strategies and tools that companies have to use. For us, I guess we raised $50 million back in July, and therefore we can work with all kinds of different companies to help them understand and overcome those challenges. terms of companies we work with, I guess Santander, Curve, yeah, different payment companies. So yeah, just going to round this, I guess, in terms of RegTech, it's still early days. We still see this kind of Cambrian explosion of different forms of companies. It's still very early on. I think the fact that companies are still behind billions of dollars every year, the fact that most companies, particularly in the fintech space, have as their largest cost base and largest overall headcount area is compliance, shows that this particular area of RegTech is only growing. And as the EU in particular, as a regulatory superpower, attempts to superimpose its regulations not only on its own citizens but also globally through extraterritoriality, shows that probably regulation is here to stay and will only grow going forward.
Fantastic, Charles, and thank you very much for showing us what's going on, but more importantly, I think showing us a little window into where things are going, because the old way of doing this, which was to sort of try to erect high barriers to keep the bad guys out, and then filing transaction reports and whatever, is manifestly not going to work in this new world. And I mean, I know this sounds very flippant, but basically, if we let the bad guys in, then we can at least find out what they're doing, and guys like you can actually find the real wrongdoing, the real bad guys, and I think that's a much better approach for society as a whole, not just for costs of compliance. So anyway, the point is, I stand around in the pub moaning about this stuff, whereas you actually go out and do something about it, and I'm blown away by what you're doing, Charles. Thank you very much for joining us. Okay. Well, that's our morning session concluded. So I hope you'll join us this afternoon. We'll be back here at 3 o'clock, where Gary Burgess will be with an old friend of mine, actually, Nick Ogden, and they're going to be talking about some of the big themes in fintech and highlighting one or two of the areas where there's some new stuff going on, where companies here can take advantage of, and where people all around the world can see what Jersey is doing here too. So thank you very much for the morning. Thank you very much for joining us for the morning. Look forward to seeing you this afternoon. Bye, guys.
Thank you.